Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we're here for another market strategy weekly video. I'm thrilled to be joined by Todd Sohn, a technical strategist at Strategas, to give us some market commentary and talk about what's going on. So Todd, thanks so much for joining us today.
Hi, Ross. Thanks for having me.
Yeah, happy to have you here. So let's jump right in. You and your team recently wrote a great piece, and it's a perfect way to end here because we just capped the first year off the bear market lows. Truly astounding year, plus 75 or so percent, and one of the best years ever. You guys dove into what year two off a bear market low looks like. And I was wondering if you could give us a couple high level takeaways from your research there.
Yeah, absolutely. It's a great question. And as you said, up 75% over the last year, one of the best we've ever seen, a monumental surge. Now, there's two things to know with momentum surges. They are very bullish in the long term, but we should expect in year two things to be more difficult. It's not going to be this linear move like we saw the last year. And you tend to actually see more tepid returns, perhaps more in line with standard historical averages, as well as an increase in volatility, right? There will be a pullback along the way. How sharp and how long it is remains to be seen, but we should expect higher volatility. I don't think it's unreasonable to expect a year where you have the economic backdrop outperform the stock market, whereas in year one, coming off of bear market lows, it's typically the stock market outperforming the economic backdrop. So yeah, I think let's get more reasonable in line with what returns will be, but the structural case is still there, at least over the next, say, year or so. That's when the momentum surges start to come back into play and returns come above average again.
That makes a ton of sense, and that leads into the other thing that you all looked at, which is stock market performance in the best GDP years. So it's a different data set, but a very similar kind of conclusion, right? It's best GDP years, best economic years aren't always necessarily reflected in stock market outperformance that specific year. Almost the reverse of 2020, where it was kind of flipped and there was a lot of anxiety over that.
Yeah, absolutely. You look historically in the 1980s or in the 1950s, where you had this great GDP growth, but the market already seemingly priced that in. You had the surges come before that, right, off of the low to start these new bull markets, and then the economy catches up. Market eyes are priced in, and you see stocks really just take a breather to digest all that data. And once a new catalyst comes into play, that's when the structural bull market starts to resume higher. So that could be a good roadmap here going forward, just to expect great news on the economic front, but again, more tepid returns, at least in the near term.
Sure. I think it's a good, mental kind of recalibration for investors to kind of get their heads around as we're expecting, blockbuster GDP growth here this year and next year. So you mentioned something, and I didn't have this question written down, but you all have done a lot of work on the idea of structural bull markets and how when the pandemic hit, we were really kind of, about halfway through what you would expect. Can you explain that concept a bit and just talk about maybe what the pandemic meant for resetting those expectations or not?
Yeah, you think about how markets work over the long term, right? They have these big regime type changes, and a great way to measure just how many times there's a new high being hit over the course of the year. And we have a great chart that shows throughout, say, the 90s, new closing highs were being hit by the week, but in, say, from 2000 to 2010, those new highs dried up. They started to expand again once 2013 occurred and the market broke out. And so these moves happen in basically 10 to 20 year timeframes. And we think we're in the midst of one of those starting back in 2013. Now, perhaps a good analogy here is that COVID was this market's 1987, right? Bull market started in roughly 1982 and all the way to 2000, 18 years. There was 1987, though, there was that crash that occurred. It might be our analogy here, where COVID, the 30 or so percent decline, was this regime's 87 type crash. And so, as long as the market continues to go in this linear upward movement, it's still a structural bull. You just take a chart of the S&P and it is up and to the right. It's not going sideways like it was in the 2000s or even in the 60s or 70s, right? That's just a simple structural bull market in this case.
That's great context. I think it's a really good framework for how to think about markets right now, which are challenging or more challenging than last year going the next year or so, but longer term in the midst of a structural bull market that should be, really cause for celebration amongst equity investors. So, we appreciate your time. Thanks so much for jumping on with us. Your insight is really appreciated. Todd, hopefully we'll talk again soon.
Thanks, Ross. Appreciate it.